partnership between DiploFoundation, ITC, CATS, UNCTAD, and the Geneva Internet Platform. All these organizations, in our day-to-day work, we have come across several discussions related to blockchain more generally and Bitcoin more specifically. I'm sure that you have heard as well that blockchain is a very important and interesting emerging technology with applications that go well beyond digital commerce. Blockchain has been applied to enhance trust and security in fields that range from democracy and transactions with the government to the financial systems, and the list of applications goes on. So it's a very promising technology. Besides that, if you were as well in the WTO public forum, in many sessions, several speakers pointed out the fact that blockchain also has applications on digital commerce, not only as a technology that underpins the development of digital currencies as we studied, but also as a technology that has the potential to enhance as well the transactions between the parties involved in digital commerce and the government. So it has been everywhere. And I'm sure that you have a lot of questions that you have asked during our module in which we discussed blockchain and Bitcoin. And some of these questions I have forwarded to Arvin myself. But during our discussion in the weekly chat, many of you have pointed out that there were still questions that remain, or that you would like to explore some of the issues in a little bit more depth. So I suggested to you that we have someone who is a specialist that could interact directly with you, and that was the reason why we organized this webinar today. So it is our pleasure to have here with us Arvin Kamberi, who is a curator and specialist on economic issues. He specifically covers digital currencies, blockchain, bitcoins, and other digital currencies that we're going to talk about for the Digital Watch, which is the observatory hosted by the Geneva Internet Platform. It's a very interesting source of day-to-day information too, if you want to remain up to date with what is happening in the world of blockchains and bitcoins. So the way that we are going to structure this conversation is that Arvin is going to make a brief introduction to give a general overview of the topic, and you feel free to ask your questions in the chat. I can then make these questions and read these questions to Arvin out loud, and to the extent possible, I'm sure that Arvin will try to keep track on discussions on the chat too. I know that you have touched upon several points, such as what are digital currencies, what is the difference between centralized and decentralized currencies, do they have an application, are they connected with crime, can they be used in something that is more positive and meaningful and contribute to development, especially to financial development in developing regions of the world. And these are some of the issues that we're going to touch upon in this webinar. So do get your questions ready. You already know how it works when we interact in the chat. I'm going to help Arvin to keep track of the chat, and I'm going to now pass the microphone directly to Arvin so he can make some introductory remarks. Arvin, the floor is yours.
Thank you. Thank you, Marilia. And hi to all for this webinar. Explained quite nicely by Marilia right now what we're gonna do. So, as Marilia said, it's everywhere. This new hype for the blockchain is everywhere. On every workshop, on every new digital policy or overview, and every top 5 technologies, everyone is just saying blockchain, blockchain, blockchain. So we will just try to kind of explain what the blockchain is, because there is one major flaw to the blockchain, which maybe many of you are aware but not. It's extremely boring. So it is really boring. That's why it will be hard to to explain that, and that's why we will start from a slightly bit different perspective this presentation. First of all, let me just say that I curate the e-money virtual currency for issue for the Geneva Internet Platform Digital Watch, and that is the place where you can find all most recent updates regarding the virtual currencies, cryptocurrencies, and the things related to development of blockchain. So let's start first, of course, first thing first, why we have these prefixes e, digital, virtual, etc. There is can I say a really big number of words which actually explain a similar stuff. So this might be might lead us to a slight confusion. So let's just shortly try to explain what this is referring when we say e-money. So first of all, when we say e-money, let's be straight that we are talking about fiat money. This is euros, dollars, pounds, etc. So e-money is a term for representing financial transactions via internet. So bank deposits, electronic fund transfers, payment processors such as Visa, etc. So this is always associated with, let's say, so-called smart cards issued by companies such as Mondex, Visa, etc. So when we say e-money, and basically when regulators say e-money, they're thinking about the banking, sending and receiving protocols for a fiat money, regular currencies that we use every day, such as dollar, euro, etc. And beyond the e-money, there is now a myriad of expressions. And first is digital currencies, of course. So digital currencies is an overarching term for virtual and other currencies, and for something which is called prepaid cards. This is all kinds of unregulated digital money, not issued by the central bank, usually issued and controlled by its developers, and used and accepted among the members of specific virtual community. So, as an examples of this, we can see, as I said, prepaid calling cards, all kind of gift cards, payroll card, reality card, every kind of stored value stored on a digital carrier, which is not centrally controlled and centrally issued. So as a subset of a digital currency, there are virtual currencies. Virtual currencies are often related to, I'd say, a system of value which is transformed through different services on the internet. Not necessarily financial services, but other kinds of services. For virtual currency, we usually say that is like online game currencies. Let's say you play some kind of game and they issue some kind of tokens. That would be a virtual currency. Also, any kind of, I'm not sure, do you realize there is online worlds outside which are also having their own currencies, etc. So this is a realm of unregulated currencies, not backed by a central by a central bank or a central financial issue, but actually accepted among the members of a specific virtual community. And as a part of virtual currencies, we, of course, have cryptocurrencies. But prior to go to the cryptocurrencies, we will need to see what actually was triggered this evolution of money, this evolution of digital money. And to do that, we first need to start from a hi to everyone joining now. First, we will need to start from a basic internet protocol, which is called peer-to-peer. I heard it, I guess, many of you heard about the peer-to-peer protocols. But what is the most important part, and why we are actually talking now about peer-to-peer? Well, peer-to-peer is a network in which connected nodes, interconnected nodes, or peers, share resources amongst each other without the use of central servers or central administrative system, to say. Peers can make a portion of their resources, such as programming work or disk storage or network bandwidth or anything else, apart from their resources, directly available to other network participants. So you can actually share without the need for central coordination by servers or some kind of stable hosts. Distributed messaging system like that, like this, peer-to-peer, is an actual backbone of the internet. It is the first proposal for an internet connection was peer-to-peer, peering. Distributed messaging system that is exactly the same as the peer-to-peer architecture was actually established by Usenet and developed in 1979. So this is the first notion of a computer networks. Later, Sir Tom Berners-Lee actually had a vision of an internet which will all of us be both sender and receivers of information. So basically the entire internet as we know it now, it's built on a simple peer-to-peer. It started from a simple peer-to-peer idea of connected computers. Of course, after this late 70s and 80s and mid-90s, we had a new server layers connected to the internet, which actually delivers a server-based network. So as you can see on this graphic, this is how actually peer-to-peer networks are connected. You see it on the right. Every computer is connected to every computer, opposed to the basic internet level server-based network, which is connected. Every computer is connected to a central server, pinging information from there, and central server is resolving your ping. In peer-to-peer networks, everyone can directly connect to each other without a central place of control, which is important for us to realize how cryptocurrencies are possible. So, when we say peer-to-peer, in an early internet, peer-to-peer was 35 to 40 even % of all network created to an internet. Nowadays, peer-to-peer protocols are really also really popular, and they're accountable for around 10% of entire file sharing systems on the internet, including all file sharing services, Google Docs, etc. So it is still there are still a vast networks of peer-to-peer computers. So what is today's protocol or standard, which is the main for the peer-to-peer, is bit-share protocol, invented in 1997, I think. And it is a protocol which in peer-to-peer networks, people can actually share the files by just sharing a bit of it. So I have one bit, you have one, and collectively we can share as a one document. So most important or most prominent use of bit-share protocols are, of course, Facebook. Facebook is using it to share around their services and their servers. Twitter server file sharing, of course, it's also on bit-share protocol, which has peer-to-peer. And the popular torrent site or sites for downloading and peer-to-peer connecting for exchange of digital data. So this is the basics of idea why and how we can actually connect in a form to create cryptocurrencies. So remember, peer-to-peer, this is really important. So this actually takes us to the issue when we say how cryptocurrencies were possible and how they're actually created, is that we need to have a bit of historical background on this. So the notion of decentralized peer-to-peer network system for payments were there, as we saw, almost from the beginning of the internet. So the idea is, as we are sharing the files, we can, like that, share information on transaction or even the money in a late stage. But this was a kind of not possible, because peer-to-peer networks were not designed with the safety on mind. So they are not designed to actually have firewalls. They're not designed to be how can I say, protected from the malicious sources. This is an open networks in an early stage of an internet, and as the rest of the internet actually, and the rest of the protocols, they are not designed with safety on their mind. So this was not quite possible until there was a few inventions that can actually make it possible. First of it is a proof of work system invented in 1996 by a pair of German scientists, which actually invented in the purpose of preventing spam on the internet by adding a simple mathematic task to your processor prior you're doing something on the internet. For example, you're sending an email. When you press send, your computer actually produces some kind of work, so the network can rely on that and say that's really you, that's your processor, and that's how you send your email. Why this was incentive to prevent spam when you send like 10,000 or 10 million emails. To remember, in 1996 and early 2000, spam was a big problem, and sending tons of emails was actually a business model for many companies. Spamming through email were big those days. So this was invented kind of to eliminate economic incentive to actually do this. When you send 10 million emails, for example, you will need like 4 or 5 years of work of your computer to send those. So this one small piece of software called proof of work is, of course, it's enhanced and worked on, and in late 90s there was a Hashcash version of proof of work, a proof of work called Hashcash, which do exactly the same but uses a nice new cryptography, and basically it's a top-notch proof of work. Another invention which was late 90s and early 2000s, which were actually made this all possible, is an invention of SHA algorithms, or SHA algorithms for cryptography, which are developed by a national security agency in the USA National Security Agency, and it's a usual and regular crypto protocols that are used today. But most importantly, the invention that actually bring all that together was an invention of a blockchain. So what was that? On early 2080, on a cypherpunk email list, there was a notion of privacy being disturbed, are digital privacy in a digital era being challenged, and many of us cyberpunks, I'm not sure are you familiar with that, but the people who actually work with on a privacy, on our personal privacy. Some of them are, like, for example, Mr. May, main engineer from Intel. They said that there is a time for changing a paradigm in privacy. In a digital world, we want to have a mathematical proof that that our data is protected. So this cyberpunk movement, actually a movement around strong cryptography and strong personal privacy, led to, as I said, invention of this blockchain. But first, we need to see a moment when this invention was set on a stage. The moment is late 2008. The world was in a devastating world crisis, economic crisis. It was like Blood Events Day and all of that events, which led to collapse of stock markets in state and in many other countries, and basically a lot of people lost all of the confidence in financial institutions. Early 2009, and actually right after the economic breakdown world economic breakdown in 2008, on the internet there was an idea of enhanced privacy model through a blockchain. So what you see on this picture is an expert from a paper released in 2009, which is called Bitcoin White Paper, released by a group of people which they call themselves collectively Satoshi Nakamoto. This paper actually presented a different kind of trust, a different kind of trust model for a new generation, or let's say for a new age. So what this Satoshi Nakamoto actually proposed in its proposal for the Bitcoin, as we see in the traditional privacy models, we had like identities, transaction, and we need to have a trusted third party which will be act as a monopolist and to be trusted to prevent any kind of in financial worlds, let's say double spending or any kind of a false action that can be imposed by a counterparty, let's say. Trusted third party. This was a privacy model we had in transaction and standard transaction for ages. So in a new privacy model, or in a blockchain privacy model, the trusted third party is actually not needed. Why is that? Because everyone can identify itself and publicly transmit their address through a peer-to-peer network. As we described earlier, peer-to-peer network was available to everyone. Sorry. Peer-to-peer network was available to everyone, which is actually the easiest way to mass spread actions. So this new version of privacy, or this new version of eliminating a trusted third party, is what created a blockchain, or what created a virtual cryptocurrencies at the end. So distributed trust. How does a blockchain works, and how does transaction over the blockchain works? This is a nice illustration we developed in Diplo. So let's say that, as usual, Alex is sending something to Bob. In this case, let's say Alex is sending something to Maria. So how does the blockchain verification works? Let's say you send us a certain amount of cryptocurrency or other currency. That transaction, alongside with many other transactions which are happening right now, are put in a one container or a one block and broadcasted over the vast peer-to-peer network or broadcasted on a blockchain. Everyone who is connected to this peer-to-peer network and actually looking at the blockchain can verify that that transaction is possible. Verified transaction and actually help that transaction to be accepted in a chain. So during the time, in this case, we represented the Bitcoin blockchain, which generates one block in 10 minutes. So in a matter of 10 minutes, this transaction is created, put it into the blockchain, broadcast it to the system, and therefore it's ready for spending. So this model of instant distributed ledger on an internet is, as we all see, a way with the really big advantages. Let's just take a look at some of those advantages in cryptocurrencies. First, of course, limited control or controlled supply, to say. So, supply can be controlled. Bitcoin, in a case of a Bitcoin, there is 21 million Bitcoins in algorithm. There is going to be 21 million Bitcoins. But you can anyhow limit what will be amount of currency you will issue. Other advantage can be small transactions. Since peer-to-peer networks are big and there are many transactions in seconds, miners or people who are actually securing this network are rewarded by a small transaction fees. So those transaction fees are way lower than a usual way of payments, of electronic payments, especially like Visa, MasterCard, etc. So this is one of the incentive of actual widespread use of cryptocurrency. The next is immutability. All transactions broadcasted to a blockchain are immutable. What that means that one cannot get back and back in a blockchain and actually delete or anyhow change this transaction which happened earlier. This is of course because of a proof of work, which we said earlier, and an encryption used in the blockchain. Third major good thing to say about the blockchain is its transparency. Every transaction is broadcasted to the blockchain, means that everyone connected to a peer-to-peer network can see that transaction, can see it, refer to it, and of course later it can be traced. And so this feature actually prevents double spending. Immutability prevents double spending, and transparency is gaining us a great tool for any kind of control over the money flow or control over foul use of cryptocurrencies, virtual currencies. This transparency is actually harnessed by, let's say, United States tax IRS. IRS is actually scanning blockchain to see what kind of transaction is happening, who is sending what to whom. So in that sense, they can actually have a quite good overview of a money flow. But let's understand that regulation is also what's, just to clarify, I will try to really be fast. I'm just flying over some stuff, but please, you guys should ask whatever you need to know. But I just need to say a few things which could be, which will use to easier to explain better, you know, what to better answer what your questions, because many of the questions are actually related to this hierarchy, peer-to-peer encryption and regulation. So let's quickly go over this presentation. Regulation of cryptocurrency. I had put a few examples here from the major West democracies. Let's say in USA, Bitcoin is and other virtual currencies are commodity, covered by the Commodity Exchange Act, so they are treated like a commodity. In Japan, their cryptocurrencies are a legal payment method now from the April 2017. EU, regarding the European Union, there is a court case from 2015 in which European Court of Justice is actually take a decision that transactions to exchange the Bitcoin virtual currency for traditional currency are exempt from VAT. So, and in Australia, their financial regulators are saying that, in their opinion, based on current literature, digital currency would meet the definition on intangible asset. So we see that is a payment method, commodity, intangible asset, and not actually are exempt from VAT, which is basically none of them is treating them as a currency. None of this regulatory frameworks is treating virtual currency as a currency. So far, they are treating it as a commodity or some kind of a store of value, an internet store of value, similar to internet gold or something like that. So this is regarding the regulation. Of course, the regulation is vague and there is no many regulators takes on regulating crypto and Bitcoin, because the peer-to-peer networks are really hard and almost impossible to regulate. Also, the peer-to-peer networks are globally spread, so jurisdiction is a really big problem. Also, and on the third way, blockchain, as we saw, is using encryption and a really strong encryption, strongest possible right now. And as we know, encryption is currently a big issue. What to do it, how to regulate it? Is it, encryption usually can be banned or allowed. There is no middle place for that. So there are not many developed regulation around cryptocurrencies in the world, but this is few major examples of major economies, world economies, how they actually trying to regulate this area now, right now. As you see, none of them are actually saying that cryptocurrencies are currencies. Regarding the negative regulation, let's just mention that Bitcoin is not banned almost. It's banned in Thailand, I think, and in Venezuela, and Bahrain. And that's basically, those three countries are deliberately banned Bitcoin from and cryptocurrencies from their countries. But aside from cryptocurrencies and virtual currencies, cryptocurrencies, blockchain and its main features are really something that we should look at. This technology, it will help us largely in sharing economy and autonomous systems. So this is why is this big hype around the blockchain. Blockchain is actually a nice, how can I say, a background to a better connected, peer-to-peer connected future economies on the internet. Why I'm saying this? Because there is one notion of one enhancement of a blockchain through Ethereum platform foundation. I guess you heard about Ethereum, which actually offered something called smart contracts. Those contracts are self-fulfilling contracts based on a peer-to-peer technology. For example, let's make it blunt. You're working for someone, or someone is working for you, and you're expecting their deliver, I don't know, some kind of digital work. Let's say you have a website and you hire a designer to actually do something on your website, and you're saying, and you can make a new type of contract, like a smart contract, which does not require you or him to actually, put in motion this contract, but it is automatically put in motion by the things which are right in it. So in our case, you're hiring someone to help around your website. You make a smart contract with him saying, when your job is done, I will deliver, let's say, $100. So these kind of contracts are fulfilling at the moment when he's compiled his work. Automatically, some kind of value is transferred to his account. So we can easily see how these smart contracts can be a new layer of interaction. How these smart contracts can lead us a new way into many fields which are now open. I just put a few of them, like in governance, in health, in land titles, notary, of course, media, and many other. For example, I guess you heard for flight delay compensations. So if the flight is delayed or cancelled, you get an automated instant payout from this website, for example. Here it is in chat. This is for a flight delay compensation. Small smart contracts implemented into real life, to say. So this is a solution. Your flight is delayed, cancelled. You get automated instant paid out, without your claim for that, without a trusted third party, and without all these middleman positions we had in an industry. And why I put the machine-to-machine communication in this? So, of course, the future, as we all know, is in Internet of Things, in a world which is connected to the Internet. When I say world, I mean every device connected to the Internet, not just smart devices. We not call devices smart anymore, I guess, because all of them will be smart, which means actually connected to the Internet. So blockchain and smart contracts can create a new kind of economy, machine-to-machine communication economy, which can also be reliable, as we saw it from the features of blockchain, reliable, immutable, automated, and transparent. What can be one example of this? Well, we had a nice example from a president of I think it was a Ford automobile industry or something like that. Someone from the auto industry saying that they will make the cars which will be able to actually interact with objects in front of them, such as ramps, for example, parking ramps, or other cars in front of them, to make an instant payment, real-time, instant, transparent payments, which will be like processed, and you're driving next to the ramp, your car is actually paying the ramp to open, and everything is automated. This is I will be quickly, I will be over quick, just wanted two more slides. This is basically how the new sharing economy is working. Sharing assets, sharing recommendations, renting fees, and this is how smart contracts can help us a lot. But just to have in mind is today talks on blockchain and Bitcoin are quite different. There is a two large group of people who are actually, as we saw, have a large say in this community. The first are cypherpunks, people who actually worked on a privacy, wanted absolute privacy when you go online, wanted obscurity for it, and that part of crypto community actually gave a can I say bad name to the rest of crypto community, which, because we heard about crypto and Bitcoin, etc., as a currency for buying things on darknet, illegal substances, drugs, etc. That's because the inherent privacy was intended to be in a blockchain and a cryptocurrency. Nowadays, blockchain is not so obscure, it's not so private. There are many people who are arrested by paying via Bitcoin on darknet, and they are, of course, traced and pulled and arrested, to be honest. But there are many other cryptocurrencies which are strongly emphasize strongest possible privacy. Some of them are Zcash, I guess you heard it, or Monero, which is a really obscure and privacy-related cryptocurrency. That's the one part of crypto. And another part of crypto is, of course, financial institutions, payment systems, fintechs, what we call financial technology. So all those companies which are actually just interested in a fast, reliable network, worldwide network, which will make thousands and thousands of transactions in seconds, which are reliable for users, for owners, and for everyone. This is another part of crypto. So the best pick to actually represent where we are now is this one. Yeah, this one. This is Lawrence Peter Krausen, Danish explorer, author, journalist, anthropologist, mostly known for his work on Arctic exploration with his wife, of course. So this is a kind of a paradigm of what is the crypto world now. I'm done here. I had a few more things to say, but I'm done. Let's have questions.
Thank you very much, Arvin. That was, as always, a very interesting presentation. I was joking with colleagues last week in Berlin that, okay, we understand what digital currencies and blockchains are, but don't ask us to explain because it's just too complicated to put in simple words. And I think actually you do it very well. So thank you very much for being with us again today. And thank everyone who is participating for so many questions. We do have a lot of questions for you now, Arvin, that have been collected throughout the discussion. So, as you know, there's a lot of regulators and people that work for the government. So we have plenty of questions related to regulation. The first of them was posed by Guilherme, and it's related to intermediation, which is something that we touched upon in the course, the process of intermediation and de-intermediation the technology brings. So would you say that Bitcoins and blockchains are sort of balancing the game towards the de-intermediation, taking intermediaries out of the game?
Definitely, definitely. There is a great study, I will just try to find it in a few seconds, a great study from a central bank in Finland, exactly on this. And it's, I will have a minute and we'll find it. But I would totally say that, yes,
If you
no
can find it
intermediaries,
right now,
that's,
don't worry, we can
yeah, I
have
will.
the class right after we speak.
Yes. Well, they call it a monopoly without a monopolist. So this is still a monopoly. Let's say there is still a monopoly of central issues, but without a monopolist. And the algorithm is a monopoly. So we don't have to enforce an overview or a trusted party to actually overview other I can say other parties in transaction to see are they fake or real, etc. So there is still a monopoly, but without a monopolist.
Another question was related to the different definitions. You showed a lot of definitions that are being adopted by countries who are trying to regulate. And what is the reason for the different definitions? And if it's so hard to regulate digital currencies, then how can we make sure that we prevent illicits that are committed in which these currencies are a part of the game or the payment that bandits charge online?
First of all, I think the crypto is in an early stage. As we saw it when I explained it in structure, peer-to-peer networks were the first thing on an internet, and they were unregulated. Then we had a layer of a server-based services, and those were also unregulated. Then we had a layer of services, as we know it, websites, etc. And only then the regulation was put in place. So basically, an IGF4 started, etc. So I love to see. I often compare the history of internet with the history of a blockchain. So what we're having now, we will certainly have a reliable Lightning network around the blockchains, which will be for the services of paying stuff, just like Visa or MasterCard. They're happening right now. There are many developments, what are called the Lightning networks, which are fast, reliable networks, which are only based on a blockchain, but will have a prominent, how can I say, will have a almost identical design as MasterCard is having now. So after that, we will have like I say, a place for a regulation. Right now, there is no one tangible thing that you can regulate. So especially when it's used almost 80% as a store of value now on an internet, rather than a currency, rather than a paying currency. So I think that crypto is in early stages. We will see the regulations soon. But when I say soon, I mean when we go over this primary level of blockchains and put another level on it, similar as we did it on the internet.
There's a follow-up question coming here. So if algorithm is a monopoly, so then how do we prevent market asymmetry? For instance, if a party tries to inflate the real value of a cryptocurrency, and you made a comparison between the regulation of the internet and the new digital currencies, but is the internet properly regulated today? Are we moving towards a stage in which digital currencies are going to be properly regulated, or is this just not possible?
I'm really hoping that we are. I mean, we are working on it. This is uncharted waters, to be honest. I mean, this is uncharted waters, and we are there to kind of be a captain of this ship. We should not have same mistakes we had on internet to be now reproduced on another peer-to-peer network, which is called blockchain. And I'm certain the regulation is coming, but the regulators also need to be a bit more creative, because those are new things, how the things are working. And just to add on monopoly and algorithm is already written. It's publicly, it's open, it's there for everyone, it cannot be changed. So we do have a, how can I say, pretty certain image of what will happen, how many bitcoins will be, how many coins will be minted or mined, to say. So we have a quite clear, how can I say, overview of algorithm. I would say the algorithm is way easier to handle than a body full of people with regulation.
Besides regulators, we also have some practitioners here in the course with us. So another concern that seems to be important for the class is in e-commerce, in practical terms. Are you aware of a company that is using bitcoins or other kind of cryptocurrencies as a method of payment? And how can these currencies actually help SMEs and help developing countries to engage more in e-commerce?
2017 and all this hype around Bitcoin was actually not good for Bitcoin merchants. Since this is the first year ever that there we have a decline in actual number of transactions via Bitcoin paying system. Which sounds weird, but it is a case. Why? There is a lot of uncertainty around the price of this kind of store of value, such as Bitcoin. So we had vendors all over the internet which were, keen to actually accept Bitcoin and accept it as a currency. But again, they needed a buffer, they needed an intermediary, they needed a card company or someone who will actually, how can I say, implement those in a day-to-day payments. Because number one, Bitcoin network and a blockchain is really small. It can process only 12 transactions per second, which is really low. Especially global, it's really, really low. This is not the size of the network which can actually, that can actually serve as a global payment system. It's not. It's blockchain database is big. It's have around 8 gigabytes now, so can't everyone download it on their mobile, etc. There are lighter versions actually doing a server-based approach to a blockchain, which are just loading 10 last blocks, not entire blockchain. So, as I'm saying, as I said previously, in order to be accepted as a universal payment, it needs a large, robust network on top of it. We are not here right now. We are not there. Right now, it's used Bitcoin. If we talk about Bitcoin, of course, it's used mostly as a store of value. We are not there to have a full global payment system because this needs to be big. This needs to be really big in order to facilitate all transactions we needed. As I said, we are waiting for the next level to be added on a blockchain. And one thing about, just to reflect on terms, different terms used, almost every regulator who's tackling this issue is just putting their own prefixes in front of it. I mean, in States there is no virtual currency, everything is digital currency. In EU we don't have, we have virtual currency especially, and we have digital, and e-money is under the e-currency. I mean, as I said, uncharted waters are hard to navigate, but we need also, as we need a regulation, we also need, as we needed in an internet, a nice taxonomy which will actually explain why and how is this happening, which will be universal, of course, and accepted.
A specific question coming from Jill, if I'm not mistaken. So imagining that a small company accepts cryptocurrency as a method of payment, can it help them deal with the devaluation of their currency? We know that some countries face a big problem with currency devaluation. So would that be an option for an SME in such a country?
Indeed, that is an option, and there is a real life user case, which is Venezuela. The country of Venezuela is in a turmoil, as you know, and even if it's illegal to actually bind or have a Bitcoin in Venezuela, that is the only, how can I say, only way they can pay for something online. So this is in vivo actually experiment on how this can help exactly as you described to basically and as we know, many countries have issues with liquidity or with how they're doing finance, let's say. Many of central financial institutions are actually looking into the Bitcoin because into the blockchain because they can issue some kind of controlled currency which they can actually firmly control the primary emissions and every other emission. So yes, there is even a real case scenario in which is happening right now, and it's Venezuela.
We have another question coming with regards to security. I think it's connected to the previous one because it is such an important tool that can be used even to preserve the value of some coins. Then what about security? What are the main issues related to security and how do we prevent them?
There are issues to, in a way, the security of your personal security or overall general.
I think that both, but I would reflect on security of technology too. I think it was Baker that commented on the 51% attack and how it affected trust.
Security of a network of Bitcoin blockchain network is now famous, to be honest. There is a 9 years of hardest attacks possible. 9 years of bombarding a blockchain with how can I say, some all varieties of ways and tries to push it to some kind of broke it. But there is one ability of blockchain which is what makes him so secure. It's so-called forking. Well, as we said, it's a chain of blocks, but in any point, any of us can actually make a fork from one block and continue in another direction. So how is this actually related to security, and especially with the 51 attacks? But first let's explain what's a 51% attack. This implies that if someone in the blockchain network has a 51% of all computer powers of that networks. For example, there are peer-to-peer network of seven computers, and I own 4 of them. Let's put it plainly. So I have more than half of whole processor power of this. I can, in that case, reverse the last transaction in the last block and do a double spending. So that's the only case how this blockchain can be insecure, which is that honest nodes in a network are having a majority over the honest nodes in a network. But that does not necessarily mean this will break blockchain or Bitcoin or whatever. The chain with the most value is the right chain, not the chain with the most hash power. Because hash power is securing a network, but doesn't give it an incentive that network to be, how can I say, to be most valuable. The chain through which we send transaction is the most valuable chain. No matter if that was an original blockchain or some kind of fork or another fork. So this kind of Merkle tree design is really, really handy for deterring the attacks, to be honest. So 51%, if someone had a 51%, let's say hashing power now of a Bitcoin network, which are now mining Bitcoin or actually securing a Bitcoin, checking all transactions in a blockchain, are 500 times bigger than all supercomputers together. So in order to someone to have a 51%, there was an estimation a few days ago on the internet, I actually read it. One would needed more than $400 billion just to start it. And to do what? To reverse one transaction? I mean, it's not a wearable product. Another thing which can actually affect not just the blockchain, but the entire encryption right now is appearance of quantum computing. But of course, as appearance of quantum computing, I guess that well, we will have a quantum encryption then. So.
Technology always tries to catch up in a way. So, colleagues, we are approaching the top of the hour. I don't necessarily have further questions with me. Baker just thank you for the analysis. It's interesting to hear this analysis on the 51%. I particularly like that. I think that you put together two different views. You do highlight the interesting developments that can be achieved through blockchain, but also you keep the feet on the ground. It's not something that is going to completely substitute what we know as a financial system. So it will be very useful in some niches, but not in everything. So that's very interesting too. Some colleagues had problems to follow the audio at some parts of the webinar, but just to reassure everyone again, we will make available the video to the class and also the PowerPoint presentation. So we will have access to that for those that arrived a little bit later too. So I would like to finish by thanking all our participants for being here today. We know that this is an additional activity for you, so thank you very much for taking the time for being with us. And also to thank Arvin for being with us too. And to thank Priyanti that was online and that provided the necessary support for this webinar.
Just wanted to add these resources I was talking about. This is a Bank of Finland research discussion. Monopoly without the monopolist, an economic analysis of Bitcoin payment system. Let me just put it in a chat. It's a really nice read.
Thank you. Perfect. I'm sure that we will follow up on this video. Thank you very much, Arvin. Thank you, everyone. And we'll see you soon in class for the next activities. Thank you. Have a great afternoon. Bye-bye.